Well, one of the biggest issues is figuring out ways to actually raise funding in local markets. And a lot of that has to do with the liquidity of the local currencies, your ability to hedge if you have to, externalize dividends or hedge some of the currency exposure. Now, that's influenced by many different things. The illiquidity of local currency markets. Often regulations tend to change quite quickly in certain of our markets, so it's the unpredictability of that. It's understanding things like exchange controls, currency controls, the local currency regime, and basically your ability to manage your liquidity in many of the African markets. A large part of a corporate treasurer's role is actually managing currency liquidity. Often you'll have to make payments or you receive goods that you have to convert to a certain currency. It's about cash sweeping across your different markets. It's about managing your funding positions. And what makes a lot of the African markets different to, say, European or US markets is the fact that the markets are illiquid. And because they're illiquid, your ability to transact is impacted, which basically means that you need a strategy and a policy in terms of how you do this. It's very difficult to be sitting somewhere, in Europe or the Middle East or the US and efficiently manage currencies in markets that aren't liquid or may be affected by regulations. A good example to sort of set the scene around that is the liquidity. So the rand remains the most liquid currency on the continent. It's one of the most liquid emerging market currencies. So your onshore liquidity in dollar rand could easily be $4 to $5 billion a day, and a lot more offshore. The next most liquid market might be Nigeria, where we think that liquidity could be $150 to $200 million a day onshore. So that gives you a clue about the disparities in liquidity in the different currencies. The other thing is exchange controls. In South Africa, for example, we're very familiar with exchange controls because we've had a regime for many, many years. And the whole design was about, protecting the internal and the external value of the rand. South African exchange controls have evolved dramatically, and they actually have been freed up quite a bit, making it quite a bit easier than it used to be to transact in dollar rand, whether you're sitting offshore or onshore. A lot of the other markets on the African continent, however, have not advanced to that level, and exchange controls could be quite erratic. We saw examples of that in places like Zambia, where the regulations changed quite drastically over short periods of time, making it very difficult for a locally based corporate to manage their currency exposure. The availability of hard currency is another major issue that we see. You might be sitting in places like Malawi or Angola or Zambia or any other market, and your ability to even externalize your dividends might be a real issue. So what that requires in our experience is really partnering up with somebody who's strong on the ground, somebody who has a good relationship with the regulators, somebody who can actually offer you proper hedging advice and also facilitate these flows in a different way that someone without a local presence might be able to do. I think also the understanding of the local political environment, what something like an election might mean for your ability to manage currencies is really important as well. And therefore the partnership, with a regional bank or a local bank is really important. Having said that, it also doesn't mean that someone must come in and deal with every bank on the ground. We've had a lot of instances on the continent where banks come and go. So again, the credit quality or the standing of the institution is really important. Someone like an ABSA, for example, through Barclays, has been on the continent for 100 years plus in many of the markets. So that kind of experience and depth, and also being systemic in many of these markets, is really important in just getting things done.